Tom Lee just said that this investment has a 100% success rate. Literally, that this investment has never failed in history. That's something you don't want to miss out on. Now look, in all of my videos, the rule is the same. Bottom line first, then the analysis. So I'm going to give away the bottom line first, then I'll show you the clip of Tom Lee saying what he said, then I'll share with you my analysis and my strategy for the next 3, 6, and 12 months in the market given what we just learned. Now look, the bottom line comes after this short message. Don't click nothing, don't smash nothing, don't buy nothing. Just listen. Now look, the bottom line of Tom Lee is very important for retail investors more than so-called smart money, because he's basically issuing to you a warning, giving away the most known secret in the industry. He's saying, look, this volatile environment, this turbulent environment you're going to experience in the next few weeks is going to be painful, it's going to be uncomfortable, and a lot of it is going to be by design, by the smart money, so-called smart money, to weed out and get the individual investors to get scared and sell out before the market spikes up. They're going to use the seasonality of the market, they're going to use the election uncertainty to actually get the flames higher so you will get scared and sell out. Because what they don't want you to understand is that the Fed is starting to cut rates. And whenever the Fed has started to cut rates and went into a cutting cycle in a non-recession economy, which is what we have today, 100% of the time, you didn't lose money in the stock market over the next 12 months. Not also the next 9 months, 6 months, and 3 months. Every single stop in that year has been positive. I'll share with you the numbers in a second, but basically Tom Lee is saying beware of the head fake that is the next few weeks. It's going to be very uncomfortable, but it's going to be just a head fake before the market rallies towards November, December. Do not be fooled. Do not be gaslighted by mainstream media and smart money.
I mean, I think if viewers are sort of confused, I think that's what the next 8 weeks are going to be like into Election Day. I think it's a very challenging period because no one can have conviction until they really know who's in the White House. But there are some positive sort of supports coming into play, and next week is the Fed meeting. We know the Fed is going to make some cuts, and with the inflation data being supportive and the labor markets needing some support, I think it's going to give the market some confidence. A 25 or 50 has both hawkish or dovish implications.
Right.
So I think it's ultimately whether Fed Chair Powell comes across as this is the start of a cycle where they're confident that we're moving back towards neutral. And whatever number they make is actually quite dovish and positive. From market's perspective, I think that they'd like to see the Fed sort of acknowledge that inflation is moving back as a secondary concern, and supporting labor markets while not in a recession is incredibly important. I think in the near term, we're losing visibility. And, when you don't have visibility, people get scared and they sit on their hands. But over the next 12 months, I think investors should be pretty confident. When the Fed has cut rates while in a soft landing or no landing, the win ratio or markets higher 6 months, 9 months, 12 months later is almost 100%. And we also know post-election markets almost always rally, so the November, December looks pretty good. And I think the policies of both candidates is good enough for markets to do well next year. So I think we might have turbulence now, but it looks pretty good after that. I think you still always want to own the best companies in the most important themes. I mean, that's NVIDIA and that's Apple. And they're going to really work over any cycle. But when the market begins to believe the Fed is going to move rates back towards neutral, and that's both cost of money, mortgages, auto loan rates, these are really big tailwinds for cyclical stocks and small caps in particular. So I think that's why I'd still want to make a very educated bet with high probability that small caps could do very well the next 12 months, and even between now and year end.
Now, what Tom Lee essentially is saying here is saying, look, folks, the next few weeks are going to be like turbulence on a plane. If you have your seatbelt on and you understand that no plane in history has went down because of turbulence, you're not going to get hurt. All it's going to be is uncomfortable and unpleasant. But if you're working around the galley, unseat belted, you're going to be flung into the ceiling and you're going to get badly, badly hurt. Understand the turbulence is coming, wear your seatbelt mentally, emotionally, and then prepare for it and understand that the plane is not crashing. There's no point in jumping out of the plane. Now, this is a very important metaphor to understand what's actually going on in the market right now. We will have a lot of uncertainty, a lot of turbulence, but at the end of the day, the Federal Reserve is about to start a rate cutting cycle in a non-recessionary economy. So basically this means that once the stock market realizes and believes and understands that the Federal Reserve is serious about cutting rates, and that this rate cutting cycle is going to happen in a non-recessionary economy, the stock market will price in what happened in history in every single time this scenario came up. And in every single time that this scenario has happened, the stock market gave us positive returns in 3, 6, 9, and 12 months after the first rate cut. It's not about the 25 points, the 50 basis points. It's not about that. It's about a signal that the Fed is going to send to the mainstream media, which is going to convey it to the public, which then will translate to price action in the stock market, telling everybody, hey folks, we are now no longer fighting inflation, the restrictions are over, and we're heading down to 3%. That's the message the Fed has to send. Whether they do it with a 25 basis points cut or a 50 basis point cuts out of the gate, it doesn't matter. What matters is this message comes out and the Fed does not screw it up in the language and the semantics they use to explain what just happened. When Jerome Powell will speak, every single word of his will be important to convey that message. It's very important. Think about it like the bouncer in the club. If the bouncer in the club carries itself in the fashion that nobody wants to go toe-to-toe with that guy, nobody wants to fight that guy, he's scary, right? If he holds himself up in that standard, he's never going to be in a single fight. But if he behaves like a little noodle, he's going to be challenged. So the Fed's job right now is to be a bouncer and to show the market, hey, everything is okay, the economy is fine, we're no longer fighting inflation, we're heading to 3%. That will signal to the stock market to price that as a future pricing mechanism. The stock market is always 6 to 12 months ahead of the actual economy. And if that's the case, the stock market is going to be in a positive trend for the next 12 months. And before everybody starts buying new cars and new houses, new Lambos, hold on a second. When he says 100%, he doesn't mean 100% literally. He means 100% when the economy is good. There is no guarantees that the economy is good. We think it's good. We think we're not a recession. But usually we find out that a recession happened way after the fact. So that's all assuming the economy is not currently in a recession. But yeah, officially right now, we're not in recession. GDP numbers are good. Unemployment is coming down. Inflation is coming down. Consumer spending is good. So on paper, we should be good. But in life, there's no guarantees. Now, another thing that Tom Lee is almost guaranteeing is saying, look, whatever happens, the next few weeks will be turbulent. September isn't going to be great, no matter how you spend this. So prepare for a very bad September. Now, do I think that you should sell out and buy later in October, November? No, and I'll tell you why. Because in the short term, there's no way to know how the market is going to swing. The market can stay crazy and irrational way longer than you can stay solvent. And to try and time the market and get it perfectly, the bottom and the top, it's a futile effort that doesn't work, and it's a really bad habit to build. So don't be timing the market because of something that Tom Lee has said. Now, he also says, look, I know I spoke a lot about small caps, and we think that small caps is the next best thing since sliced bread. I totally understand it. But he also says, look, folks, we don't mean you should sell your NVIDIA and your Tesla and all your great stocks and your Palantir. You definitely want to own these regardless. Don't be going all in on IWM, selling out of your entire portfolio. That's not what I meant. You see, a lot of these great companies, and that's exactly what Tom Lee's also said here, these great companies long-term are unbeatable. What you want to be is in the market. Look at Palantir. Palantir was at $10 when it DPO'd. Then it went up to $35. Then it went down to $6. Went up again right now to $37. So this crazy ride is going to happen. Do you really think you're that good to time it perfectly? The short-term volatility in the market, it makes no sense to jump in and out, trying to time this. It is a futile, stupid exercise. And if you play stupid games, you will win, I guarantee you that, stupid prizes. Now, talking about not stupid prizes, Palantir has hit $36, and I want to offer you something cool. Since Palantir is currently at $36, I'm going to give you access to my academy, which is usually $99 per month, at $36 right now for the next 24 hours to celebrate Palantir's new price target, $36 right now for the next 24 hours. patreon.com/Tom Nash. Join the academy, test it out, try it out, see if it's for you. We actually have our upcoming meeting this Thursday. We learned about how to do DCA, how to do modeling like DCF, when to sell a stock, when to buy a stock, how to evaluate stocks, all that good stuff. And look, volatility isn't going to go away. It's even going to happen this week. Look at tomorrow. Tomorrow, the Fed might shock the world. Tomorrow at 2 p.m., the Fed will announce how much they're cutting. And right now, everybody pricing in 50 basis points. Look at the Fed CME watch tool. Now imagine the Fed comes out and does a 25 basis point cut. And that kind of decision might send the market actually tumbling down or maybe up. Who knows? Maybe Jerome Powell says something crazy that does the same thing. But eventually, what Tom Lee is saying in this video, and I could not agree more, the fundamentals will win, which basically means economy, not bad, economy getting more money, cheaper money, economy good, stock market good. All of this, whatever Jerome Powell said, how much cuts they've done this month or next month, all of this is irrelevant because long term we're talking about a process that's a positive process for the economy and the stock market, assuming we're not already in a recession. And whatever happens, the market is never going to feel smooth. I've told you about this multiple times before. We have 5% drops in the S&P 500 3 times per year. We have 10% drops once per year, and every 3 years we have a 15% drop. Look at the data right now. We just came off of an 8.5% drop and a 4.3% drop just in the last few weeks. This is insane. We had a really smooth first half with no turbulence, and now we're basically making up for lost time. It just means that you cannot be in the stock market without understanding the turbulence is part of the game. Good news, it's normal. Bad news, it's normal. It's nothing to get excited about. When the market has a first half as strong as the first half we had this year, the second half is a 10% half, with 11 and 12, November and December being the best month, and August and September being the worst. It's a statistical fact. Now, whatever the outcome is, nobody knows. Some people say, well, Tom, the credit card delinquency numbers are up. The prices are up. People are struggling. There's a lot of consumer weakness that's hidden beyond the data. And yes, I totally understand. But on the other hand, you can't ignore macro data. Unemployment is coming down below 4.5%. GDP is at 3%. And inflation is at 2.5%. It's very hard to say that in this environment, we're going to cook up a recession. Now, nobody knows for sure, but there's definitely clear, strong arguments in both ways. And since we cannot predict this and time this, we have to be careful with our choices. Now, look, Tom Lee's kind of bottom line here, just to kind of recap things, is very simple, saying, look, the next 8 weeks will be challenging. The Fed is coming off restrictive rates. The economy is not in a recession. By the end of 2024, we're going to see a big rally. Now, how much of a rally? He actually brought the data. Look, 3 months average in this scenario is 8.6%. 6-month average is 13.2%, and 12-month average is 15.4%. So basically, Tom Lee is saying that from the first rate cut we're about to see in 24 hours or so, the market on average does 15.4% if the economy is not in a recession. I take that. That's not a bad thing. He also actually said that the first week after a cut is usually the worst week of the entire year after the cut, which just exactly shows you how much of this misdirection and head fakes in the stock market is designed to kind of confuse the individual investors. That's why this channel exists. Thanks so much. I'll see you in the next one.